So if you're in your 20s or 30s, or as a matter of fact, just any investor that believes in buying low, but you've been a little bit scared because you think that there might be a recession or something coming down the road, which makes you a little skeptical, then we've got a question for you. How much for the bear? No, I'm not talking about the 800-pound furry animal with big teeth and claws that's going to get
not.
you. Yeah, no, but just something just as scary, which is the current bear market, which has seemingly eaten 20 to 35% of your investments for a yummy pre-hibernation snack.
And for investors that believe in buying these dips, this market is actually a great opportunity. And that's really what we're talking about today.
Yeah. So the whole concept is that investors believe in buying at discounted prices, and that's ultimately what some call buying the bear, right? So as the stock market keeps going down, people keep investing into it in order to increase their profit margins. So as they're doing that, right now we're in a situation where the stock market just seems to keep going a little bit lower and lower and lower. It has so far this year, with the exception of a couple of months. And so I think it's got some people wondering, right? Like how much am I paying for the bear?
I've had many clients who say, do I need to keep adding because it feels like everything's just falling apart? So I'm putting in money and I have less every single month. But there is some method to this madness as long as you're not ready for retirement and you've got some time. So how do you really deal with that, and how do you do that well, and what not to do are some of the things we're going to talk about today.
Yeah. So a couple of things that we just want to talk about, and in this show, we are very good about just providing education that way. If you're not, this isn't a concept that you're familiar with, just catching you up to speed. So first of all, what is a bear market?
So a bear market is defined by a sustained period of downward trending stock prices. It's often triggered, they'll call it an official bear, at about 20% from near-term highs. So what that means is it hit a high point and it's down 20% from that. That's what defines a bear. Often, bear markets are found in the midst of a recession, which we've not officially been labeled a recession so far. And there's many factors that don't indicate that. Often with a recession, you've got high unemployment and you've got some other pieces to it as well. But if you've got that 20% drop, they can call it a bear market regardless of the recession.
Yes. And that's what a lot of people don't know, is that, in a recession, or with bear markets, a lot of times that, you see those accompanied by each other, but not always.
Yes.
Right. So in our most current bear market, which happened in March of 2020, right, it left a lot of brave people back at that point with great hopes, right, because they got really high rewards in a very short period of time.
Well, and I think many of us knew that this was kind of a black swan event. It was something that was out of the blue and would recover fairly well. Most people were confident in that. So it was a lot easier, I think, at that point for people to say, I'm going to add to it. And I got a lot of calls from clients who were younger saying, hey, what do you think? And then I'd have to be, very clear with them about what they don't need to do in those markets and coach them a little bit that way.
Yes. Yeah. So, I think that's probably where we got kind of some of the inspiration for this right here. But just to recap what happened in that bear market, right? So the S&P 500 was down about 34%, but it rebounded in less than a month afterwards. And it only took 5 months to completely recover.
Yes. And there's a huge risk of the effects of the duration of the pandemic that people were taking. They certainly couldn't guarantee that the market would recover that quickly if they were getting invested. But we had been 11 years without a bear market prior to the pandemic too.
Yeah. So maybe there wasn't a huge recency bias, right? Which, we've talked about before, that's something bad or good happening recently, and that kind of giving you the motivation, right, to act in a certain way, right? So yeah, it had been a long, long time since we had a sustained bear market where people were really, really anxious or nervous. So so I think people were pretty eager to latch onto that.
And if you go back that 11 years to the last time we saw something like that, 2007 and 2008, the S&P was down 57%, and it took 17 months for that one to recover, for that to end, and then 49 months total to fully recover. So there have been many From 1947 to 2022, there have been 14 separate bear market cycles. Most of them are lasting anywhere from 1 month to 1.7 years. So if you think about a younger investor, even if it lasted as long as the longest one, 2 years, and you're running again,
exactly,
which is healthy for the market. A lot of people don't realize the market needs the ups and downs to stay healthy. And an example I explained to some of my clients that they can remember is GameStop.
Yeah.
Remember, the price got inflated artificially and it had to balance back out at some point. A lot of what we've seen this year has been some of that, or not a lot of it, but some of that has been caused by just a need to return to the mean.
Right.
And then some of it is certainly market volatility.
Yeah, so it has to do a lot with balance. So with those other bear markets, what we typically saw was a decline in the S&P 500 between 20 to about 57%. So pretty substantial. If you think about losing over half of your investments, it's a pretty big deal. But with a lot of investors nowadays, there's a lot of retail investors now, right? So people that have their accounts with brokers that allow them to just direct their own trades and do that kind of thing. It's not completely just institutional, right? So with that, there's even a bigger probability that the markets are going to be unbalanced, right? And then creating the need for a correction or something like this, like a bear market, to happen. So of the 25 bears or bear markets, right, since 1928, only 14 have coincided with recessions, right?
So that's just a little over half.
Right.
So, just because there's a bear doesn't mean there will be a recession. Now, don't hear us saying there won't be. There's a lot of data to indicate that we likely will see one soon. But what we're trying to get at is, if you're younger, this is more of an opportunity than a risk if you handle it right.
Yep. So, and again, going back to just are the demographics of this, right? If you are 30 or under, chances are that this is the biggest bear market that you have invested in.
And a similar kind of note, if you're 50 or older, or if you're under 50, excuse me, this is the highest inflationary period you've ever lived in. And I think the two kind of have a double whammy effect for investors. They've got, less buying power, and they're seeing their investment values fluctuate. And I want to be clear, it's your investment value, not your investments. Nobody's going and stealing your shares. It's just the value of those shares is depressed. So if you're buying more shares during this time, the market recovering can happen really efficiently for you.
Yeah. So here's a few things that we are just going to talk about, which I think is probably all the things that you mentioned to your clients that were calling in, during March of 2020 and the pandemic, and saying, okay, I want to put all my money in, right? So here's some do's and some don'ts, right, that we want to make sure that you have in your back pocket. That way, as you navigate through this, if you are buying the bear, or if you're listening to us now and considering buying the bear, then, something that you will want to keep in mind.
Yes. And I'm just going to start with a somewhat dramatic one. For the love of all that is good and holy in this world, please do not invest your emergency savings. You do not want to have to pull back out during this time to pay for something that you could have used emergency savings for. And especially with inflation and interest rates having risen, there are tons of money market accounts that actually pay a little bit of interest now. Right. Whereas a year ago, you were getting, 0.0001%.
Pretty much nothing.
I just saw an advertisement the other day for 3 or 4%. So there's no reason to invest funds that you're going to need in the short term.
Yeah. So the other day, I bought a 3-month CD for 3.85% interest.
Yes, that's insane when you consider literally a year ago that was not possible. That's the kind of the beauty, the only good that comes out of these interest rate increases, is that yes, debt is more expensive, but also your interest is going to be higher on things that you do like CDs or money market accounts.
Yeah. So becoming basically a debt investor instead of an equity investor.
Exactly.
Yeah.
Another thing you don't want to is use credit cards or take out loans to free up cash to buy the bear. So don't go get a home equity loan so that you can invest it.
Yeah.
Please.
Yeah, definitely. And also, don't invest the money instead of paying off high interest debt or credit cards or anything like that. Like if you are on a debt snowball payment plan, right, and you're putting extra money, right, beyond beyond just the minimum payment, then don't take that extra payment that you're making and all of a sudden you start putting that in the market.
Even with market volatility and using the bear to your advantage, when you look at the market long term, the average return is around 14%, lowest is around 8%. If you're paying 30 on a credit card, you're not beating it by investing those dollars. So be mindful of utilizing those in the most efficient way and effective way long term. Don't get, that short-term bias and think, "Oh, I'm going to get this opportunity," because it may not work out in the short term when you need those funds back.
Yeah. So instead, do this, right? Instead, pay off high interest debt first.
Because the sooner you free up budget cash, the sooner you're going to be able to make major progress on your goals. Which goes along with the next one, which is to have your emergency fund funded. That means 3 to 6 months of your monthly expenses put in an account that is cash. So this is your bank, in a money market or in a savings account that you can access if needed. If you haven't made that a priority, make that a priority now.
Yeah. And if you are really, really determined to make headway, then consider taking up a side gig. That way you get extra cash flow to either, pay down that debt faster that you have or build up that savings even quicker.
And then if you're in the position to do so, you can prioritize investing. If your emergency fund is healthy, if you don't have a bunch of non-mortgage debt, then you've got these items on sale out there that you can buy. Now, not all sales are created equal, so use good guidance and prudence in what you're choosing to invest in. But if you're in the position to do it, then now is a great opportunity.
Yeah. And then just stay the course, right? With your current savings, your employer plan, your IRA, right? If you're contributing to if you have a 401k or some other type of employer plan, then continuing to make those contributions is also a very healthy way to just continue buying the bear, because that's exactly what you're doing, especially if you're getting a match for your contributions. That's something that we would definitely say consider doing even while you're paying off non-mortgage debt and that kind of thing.
And it's kind of an easy button for savings, because you can adjust your employer plan usually pretty efficiently. So if you've made some progress on your debt and you've got that emergency savings together, you could simply increase that employer plan contribution a little bit. And every time you get a raise, increase it a little bit more. And that's a little trick that'll get you where you need to go a lot quicker over time.
Yeah. So in regards to again, the potential, right, that you have right now. I mean, where we are right now, the S&P 500 is down about 20%. The NASDAQ is down about 30%, right? So when you think about those numbers, right, that gives a lot of people quite a bit of encouragement, right, to want to invest, because they understand, okay, I'm buying this bear at a discount, right? So even when you were talking about, back during the pandemic and what was going on, I had some investors that actually doubled their money during that time, right? But just like you were saying, you have to be very careful about the things that you're investing in.
Yes, because there are some individual companies that are still going to struggle for a while. So being careful not to just invest in individual companies, kind of spread out your risk to make sure that you're covered no matter what.
Yeah.
So it's time for our 2 cents, and I'll go first. Buying low and selling high is a basic principle of profitable investing. It's something everybody wants to do. But don't put yourself in a bad situation by buying low and then having to sell lower because you didn't have an emergency fund that was healthy. Make sure you're set up for success before you get started buying that bear, so that the bear doesn't get you instead.
Yeah. And here's the other thing. If you are nearing retirement, then this has a completely different spin for you, right? So there's this thing called sequence of return risk. And that's basically, in common terms, just means if you're retiring into a down market like 2022, right? So I can't imagine folks, that were planning on retiring this year and all of a sudden find their portfolios down 30%, right? Or 20% or whatever it is, right? So on top of, what they were already planning on taking out of their account, now their portfolio is down, right? So we talked a lot about buying low and selling high today, all right? Well, that would be the opposite for them, right? It's they probably bought high, right? Like the shares that they bought last year, they're absolutely down right now. So being very conscious about how you're going about in retirement, what you're selling, what you're doing with that, that's definitely something that you want to be careful about. So, I would definitely say we would encourage you to meet with a professional just to make sure that you have a plan in distributing those assets and getting that income from your plan.
And this is why we encourage people to start that planning process earlier. We've got clients who are retiring this year and they're in good shape because we had already put their assets in the right places to handle this bear market. So regardless of what stage of your investment life you're in, we have different strategies that can help you. And it's really important to make sure you've got the strategy that works best for your situation.
Yeah. So it's hard to put a price tag on a bear, but we hope that we've given you some good tips to invest in this market like a pro. Stay with us next time when we talk about home equity and how to use it.
Thanks for listening to the Talking Sense podcast. And if you like what you hear, make sure to subscribe to the podcast to get all the newest episodes.
The GenWealth team is available to you 24/7 at info@getreadyforthefuture.com or call our offices at 866-653-PLAN. That's 866-653-7526.
And while we like to have fun here, we're also financial advisors, and that means disclosures. You should personally consult a financial advisor before making any investment, and no strategy can assure success.
GenWealth Financial Advisors is an Arkansas registered investment advisor with securities offered through LPL Financial, member FINRA SIPC.